Well, good afternoon, everybody. Welcome back to another episode of the Industrial Real Estate Show. I'm pleased to be joined by a guest who was probably my two favorite episodes last year, so I had to invite him back for part three to see what's going on in 2025. Doug Kiersey with Dermody Properties. Doug, thanks so much for joining me once again.
Great to be back. I hope I don't disappoint, but I appreciate the introduction. Thank you, Chad.
Well, you did set the bar pretty high with your first two episodes, so there's big expectations now for part three.
Well, a lot's been going on, and I can't wait to share our perspective.
Yeah, there it sure is a lot going on in a short period of time, and I think that that's been the trend over the last 5 years now. Is that every day is just something different coming at us, and it's hard to really keep track of what's going on and looking at everything and trying to decipher what to do and how to react. But where do you put it at right now? So last time we talked, I believe, was the fall of 2024. So call it
Okay.
5, 6 months later.
Mhm.
What's happened in the last 6 months, and where do you think we're at right now?
Boy, that's broad. I'll start with the capital markets, and I'll start with valuations, which really haven't moved very much. So I looked at the calendar, and as of this month, this is the beginning of year four of the Fed's tightening regime. Year four, 3 years have gotten behind us since they started the tightening regime in the February of 22. And it's done nothing less, I think, than completely recalibrated valuations across commercial real estate, including US logistics real estate or industrial. And so we're still working our way through that. And a lot of us look up, and the first thing we do when we get out of the bed is look at the 10 year. And I looked at this morning, and it's about 424, and it's exactly where it was a year ago today. It's gone up and it's settled back down. And I think one of the things that's also happened, there's been a little bit of a decoupling between the Fed's movement, where they've taken 100 basis points out of the funds rate, and the 10 year. And so most of your listeners probably know, because they pay attention to these things, that the Fed made a pretty strong move last fall, and the 10 year promptly went up in response. And I think that has more to do now with where we are fiscally than it does the monetary policy. And that fiscal part's going to be a lot tougher to solve as a country. And again, you talked about the news of the day. It's all over the board around our current fiscal policy. Is it going to be good news? Is it going to be bad news? How long is that all going to take? In the meantime, those of us who are making investment decisions find ourselves very much in the same stasis as we were 6 months ago.
Yeah, there's all those mantras that get circulated, and the one last year was survive till 25. And for anybody that was perhaps uncertain on when things would get better, it was always just, well, next year will be better. And like you mentioned, the 10 year is the same as it was a year ago. I think it got close to five at one point, right? And then it's settled back down, it's come off a little bit.
Yeah, it's
But
been
yeah,
a bit of a peak and then come down.
and the Feds did three interest rate cuts last year, and the 10 year went up. So you're right, that is a strange phenomenon that bond traders must be expecting higher inflation than the Feds are leading on. That's a question that I don't think anybody really has an answer to on where does that converge to a middle ground somewhere? Do we see some relief in the 10 year? Do you because I'm with you. I look at the 10 year every day as well. That's just probably the first number that I actually look at. But there's not much we could do about that. We could guess, we could try reading the tea leaves and say, well, if the 10 year comes down, then maybe we'll see some compression on cap rates and maybe everything starts looking great again. But we have really no idea to determine that. How do you knowing that the 10 year is now almost moving independent of the Fed rate, at least in the short term right now, how do you start making decisions on everything from purchases to dispositions to financing strategies? How do you try to decipher all this information right now?
Well, on investment decisions, we're being asked right now to operate in a very narrow range between the 10 year at, let's say, 4.25, and industrial cap rates that are 5.25, 5.5. Now, when I say 5.25 to 5.5 range, I mean where you have assets where rents are at market. There's no gap between in-place rents and market rents. You're basically at market rents, call it 5-year WALT, weighted average lease term, decent credit, Class A product, et cetera. So when I talk about cap rates, visualize that kind of a scenario. So let's call it a 5.25 to 5.5 world. That's a very narrow spread. That's 100 to 125 basis points. If you go back and look at the generational average, call it 20 or 25-year average between industrial cap rates and the 10-year, it's closer to about 320 basis points. So we're already very narrow, which says to me that the broad investor community is assuming that there'll be some softening in the 10-year over the midterm. And I think that's sort of the consensus. There'll be a little bit of softening. If you went around the room and ask a bunch of people that are in the ecosystem of the investment world, they'd say, where's it going to be a year from now? They'd say, maybe it goes to 4 of the very high 3s. So, maybe there's a little bit of runway there, widen that spread a little bit, but it's a very narrow spread. So as an investor now, we're having to put a disproportionate amount of eggs into the rent growth basket. And we're having to say to ourselves, rents are going to grow, and they're going to grow more than the rate of inflation. And they're going to grow into an environment where we've gone from 3% national vacancy to 6% national vacancy. And so in some markets and submarkets, we find ourselves with a little bit of vacancy overhang. Well, how do you grow rents into that environment? And so it's become a very narrow pathway for investors, especially on the development side, to see their way clear to making investments. And that's why you see starts nationally completely fall off a cliff. Well, that's good news for those of us who own assets, because the competitive environment looks very attractive for rent growth in the latter half of 25 into 26 and 27, because supply has become very constrained. So all these things are going through our head. Do we want to invest into this environment expecting rent growth? We shouldn't be investing in this environment expecting cap rate compression. We should be thinking about the other half of the value equation, which is net operating income. And that's an old-fashioned concept that's now coming back into vogue. As I say to the team, we have to NOI our way out of this thing, because most of our return now is going to be income-based, not appreciation-based.
That's a wonderful perspective to take. And I think that that's lent itself very well to the industrial industry as a whole, especially compared to other asset classes, multifamily being one or office being one, where they've almost been hit by a double whammy, where office, especially where they've actually had pressure, huge pressure on their rent. And then they've had increasing expenses all across the board. Multifamily
Yeah.
has been flat in a lot of markets, and they've had multiple increases in their operating level expenses, whereas industrial has had that ability to incrementally increase rates. And we're still seeing deals get done that have escalations tied to inflation in there. That's still actually pretty common. But then some elements of industrial have actually been quite impacted over the last 2 years from that overbuild of spec big box warehouses that haven't been leased. And there's a stat that got put out the other day that big box warehouses sitting on the market has actually hit a high on how long they've been sitting on the market. So now
Yeah.
there's almost that bifurcation of industrial, where you've got big box, which is overbuilt in some markets, and then you've got the rest of the market, which is still actually doing quite well. On that big box stuff, have you experienced that a lot of that is just institutionally owned and the capital isn't stressed out yet? They're not concerned about having to fill it for various reasons? Or are you starting to see any cracks from owners that are saying, yes, we need to have NOI growth to actually support the business case on this and to actually sustain this model, so we'll just sit on it vacant as long as we have to until we get our number? Or are some owners starting to say, we just need to get tenants in here just to get cash flow, just to cover expenses?
Yeah, you covered a lot of ground in those questions. Let me see if I can take them in
I tend to do
pieces.
that. I
That's
tend to get
okay.
on a train of thought.
No, what you just articulated is really the essence of from an operating. So let's go from our investment mindset to our operating mindset, which is where you just led us. Um, First of all, Germany tries to avoid investing in the exurbs, and we try to avoid investing in the exurbs in very large spaces. We've done it in the past, but it's not our first thing. We like to be infill, and we like to be sort of that middle sized asset of 200 to 500,000 square feet. Do I want to own 1 million feet in the exurbs right now of any major US market? Not really. I think that's a difficult space. Look, a lot of smart people have made those investments and done very well. But I think you're seeing now in limited cases and in limited markets where those buildings have had a birthday on vacancy. Okay. We don't like buildings to have birthdays. That's when alarm bells and lights start to go off in our firm. When something's been vacant for a year or a year plus, you're outside of your underwriting. Let's also consider that uh, even though this institutional ownership, the sponsored developer is typically is a private firm who then puts in 5 or 10% of the equity, and the LP brings in the other 90%. But they all have one thing in common, and that is they've gone out and secured a bank debt facility to construct the asset. That typically has a 3-year life with 2 1-year options that can be exercised under certain conditions. So if you think about where we are, there was a tremendous amount of froth in the market and a lot of starts in 20, 21, 22 that in certain cases are running up against that maturity. But what happens when you reach maturity on a 1 million square foot building and it's unleased? You're going to go back to the bank, you're going to negotiate an extension. The bank is going to say, okay, well, consider an extension, but we want you to remargin this loan, i.e., put some more equity in. Where's that equity going to come from? It's going to come from the LP, it's going to come from the GP, or a combination. Nobody wants a capital call. So I think on a very selective basis, you'll see some of those buildings become I wouldn't use the word distressed, but a little bit stressed. And I think this is the year you might start to see that on a very limited basis. Remember, at 94% occupancy nationwide, we're just talking about pockets. We're not talking about the whole market, but we're talking about pockets, and those pockets tend to be in non-land constrained submarkets, which is to say you then become something of a commodity if you've got 3 or 4 competitors. That's a bad place to be. And so as an operator, you then have to say, I thought the market was going to be a $10 rent market. No one's showing up at $10. Do I make an $8 deal? Those are the decisions some folks are going to have to make. And that's going to be very circumstantial over how they do that. Now, I tell my team, forget the pro forma. If we made a mistake on the front end, lease the space. Lease the space. A bad deal only hurts once. Vacancy hurts every day. So I would say to your audience, if you have a space, meet the market, get it full. Try to keep your turnover costs low, your commissions low. Don't sign a 10-year lease, sign a 3-year lease or a 5-year lease. Try to bridge the space to another day. And that would be my recommendation. And that's how we treat the market.
I love the point about how certain markets just have unlimited room to grow, and I think that that's why Dallas Fort Worth and why Phoenix have led the nation in new developments over the last couple of years, because you could theoretically grow in every direction. That risk of commoditization, what happens? What is the investment thesis? What goes through somebody's mind that's buying a 1 million square foot building on spec, or buying land and developing 1 million square feet on spec in one of those markets, when in theory somebody could go across the street or 5 minutes down the road and replicate that building and perhaps undercut them? What is the investment thesis for one of those spec projects?
Do I have my GP hat on, or do I have my LP hat on, or do I have my lender hat on?
I guess any one of the three.
Yeah, so from a GP perspective, you have to earn development fees to keep your lights on, and so there's a strong incentive to keep that machine rolling. I think from an LP perspective and maybe the lenders, there's a part of the cycle where there's some pressure to invest, where there's liquidity inside the firms that needs to find a home. And so, we convince ourselves that we look back at the last 3 or 4 years and things have been built, leased. There's been that cycle. We don't see a break in that cycle coming. And so we invest into it. And it's a little bit like musical chairs, where when the music stops, the buildings that don't have a tenant might have to wait a while to achieve that. And so it's just human nature, right? As cycles mature, underwriting standards soften. Now we're on the other side of the cycle. Underwriting standards have stiffened, and that's why you see a part of the cycle where supply is going to be constrained nationally. And then what will that do? That will start a new cycle. And so as an operator, the key to all this is to make sure that you have as many barriers to your supply as you can, or back to the commodity.
And at any given time, you've got different cycles running at different intervals. So we might have that build cycle running a shorter cycle right now, whereas the capital market's been riding a longer one, particularly on cap rate. 3 years now. That's when they started the tightening,
Yeah,
and that's
yeah,
put
it
the
was
pressure on it.
the first quarter of 22. I can't believe 3 years have gotten behind us so quickly.
And well, in almost 5 years since the pandemic, that was
Yeah,
March 15th or 16th, I believe, when they shut the NBA down, and then hockey the
yeah.
next day. That's
And
that,
then
that's
and then
five
at,
years
at
ago.
that kicked off a hyper growth cycle for U.S. logistics real estate, as you
Hmm.
know. Rents in some markets almost doubled in 18 months. It was incredible. Probably never happen again in our professional lifetimes. The confluence of extreme demand as well as basically free money. Our spreads went from 150 basis points between yield on cost and cap rates as wide as 300 or 400 basis points. I mean,
Well,
our returns were like nothing we've ever seen, and we weren't alone. But now here we are. We're back to, more of a grinded out kind of a market.
so how are you figuring out valuations right now? Because with all that fluctuation and variability over the last 5 years also means that it's very difficult for the appraisal community to actually figure out where the market is if it goes up that quick, and then there's pressure on it so fast. And then add in the fact that there just haven't been nearly as many transactions in the last year or two. How
Yeah.
are you trying in this environment of craziness and limited sales? How are you figuring out valuations?
You know, we're hungry for every sort of data point that we can get our hands on. We're tracking every deal in the marketplace that might have any bearing on our uh, on our valuations. We mark our assets to market quarterly, and I think we appraise something like a third of our assets each quarter. So there's an appraisal cycle for all the assets. So we're getting that data from the professional appraisal community, and then we're hungry for anecdotal information about how things are trading. That's sort of how I got to those numbers that I put out earlier, kind of 5.25 to 5.5. And that's how we're marking our assets. But the crystal ball's fuzzy. But when isn't it fuzzy? 5 years ago, we were asked to project in order to make our deals pencil. We were asked to project the cap rates were going to compress, that values were going to go up. Is that an easier environment to invest into, making those assumptions? I don't think it is. I have to remind my team we were having all these difficult conversations 5 years ago when the market was moving in the other direction. We were being asked to, you know, to believe in the continuance of good news. Now all that we're saying to ourselves is let's assume things are going to be fairly static. Think about the 10-year for a second. What is going to animate the 10-year to fall significantly? This country is borrowing $2 trillion a year that's financed through that system. We're putting out a tremendous amount of supply of debt. What makes us think that that demand is going to exceed supply to such an event, such a place where buyers will of our debt will take less. I don't see it. I'll give you one stat I read, which made my hair stand on end. The federal government took $1 of revenue last year in the fiscal year that I think ended in October of 24. It took in $1 of revenue from all sources, all taxes, fees, everything. 23 cents of that dollar went to pay debt service, not principal, just the interest. 23 cents of the dollar collected. What happens when it's 40 cents or 50 cents? There's got to be a tipping point there. And I just put that out there for everyone to think about in their own lives, what that means. It's not sustainable. It is not sustainable. I'm not here to talk politics or policy, but we know that it's unsustainable. And so as I think about it as an investor in my investment decisions, I just get back to, I can't control all that stuff, but I can control great properties and great locations that'll attract great customers. This is the time to go to quality. This is not the time to invest in less than quality, whatever happens.
Yeah, well said. And I remind myself of that all the time as well, is that we have no idea what's going to happen. And even if it does happen, we have no control over it as individuals anyways.
Yeah.
And there's always something. Like if you were to look back 20 years, let's even say 25 years. It was Y2K. It was the new turnover, and there was always concerns, and everybody was scared. And you fast forward, and there's always going to be reasons to think that something could happen, and maybe it does happen. But I really like that point: is look after what you can control, as opposed to perhaps diluting your focus or wavering and looking at something that doesn't you can't influence anyways. I guess that leads to the question then, what does that look like for you? What do you see as the highest quality properties? And you alluded to it already, and perhaps some of the markets you'd stay away from. But what
Yeah.
does that look like? What is that buy box for you guys right now?
Yeah. The buy box is very simply infill. It is newer Class A properties. It's the avoidance of functional obsolescence, which means newer typically. And for us, the mix is going to be around 80% development and 20% acquisition of those types of properties. So we like to manufacture brand new. We think that creates the best results for our investors and the greatest risk adjusted returns. That's our strategy, but not every investor feels that way. But I think the focus is always on Class A, always on infill, always in markets with sustainable demand drivers. I came back from a trip to Savannah from last week. Boy, that Port of Savannah, unbelievable demand driver. Now there's a supply issue in Savannah right now if you want to take it out 20, 25 miles from the port. But if you could be close to the port and have a sustainable advantage there, that port is a huge demand driver. So we need sustainable demand drivers, institutional liquidity when we're a seller, barriers to entry.
So that excludes the industrial park 50 miles outside of downtown Dallas, where you could build
It
anything across the street.
it does for me.
Yep.
And I'm not trying to throw shade at anybody who's made those other decisions because every firm has its own bespoke strategy, but that's not ours.
Yeah, and I'd like to think that the ones that have made those decisions have probably fared very well on other decisions that they had. So there might be a little bit of pain on some of those buildings, but like you said, everybody's got a different investment thesis on how that's going to look. So I wish them all the best too. I hope that they're very successful in the upcoming year as supply dwindles and new inventory starts slowing down. I hope that they actually do very well. But I'm with you.
Well, since we picked on Dallas, I should say, uh, there was a time not too long ago when that market was absorbing 30, 35, 40 million square feet a year, and supply really couldn't keep up. So an investment thesis there that made a lot of sense. It's just that when demand slowed and those that weren't full, then it's, you end up, you don't want to be the 10th person when there's nine customers.
Yeah, well said. I want to dive into how you look at a new building right now because, from my perspective, things have changed quite a bit over the last 10 years. So ceiling heights, I'm guessing there's still some upward movement on there. Are you starting to push 40 now? Is that common, or what's your target on
42,
there? 42.
42. So for us, anything that's going to be sort of a multi-tenanted building, call it 200,000 feet, even up to 300, we're still comfortable at 36 clear. Those customers, you divide those buildings, you're running towards a customer that's 75 to 150,000 feet. And really 36 is very functional for those customers. Above 400,000 feet, everything we do is at least 40 feet. We built a million one in the Inland Empire, and we built it to 42. And I believe that was the singular reason why we were able to, in a competitive environment, secure a lease with Amazon, because we'd gone to 42. How much higher can it go? I mean, I started in this business when it was 24 feet. So it's a function of a handful of things, uh, material handling equipment, how much more sophisticated that's become, but also the fire regulations and fire and life safety and the technology around fire suppression that continues to evolve and allow for the higher heights. Also, people don't think about this, but your walls get thicker, your slabs get thicker, they're carrying more weight. And so there's a, your joists, all that has to be beefed up to pursue those kinds of clear heights. But customers are starting to see value in that, and so we want to go where the customers are.
On that topic, and perhaps it's not here quite yet, but a lot of customers are at least looking to go more automation. And with automation, more retrieval systems, more automatic, more robotics, more power consumption.
Mm.
And I think that's it's there's some that are doing it now. The big players are certainly incorporating a lot more automation. It hasn't trickled down across the board yet, but I think that will be a trend developing over the future. With all this new automation for buildings that, like, a 20-year-old warehouse wasn't built with any of this in mind, but the opportunity to build something now for future proofing it for these incredible demand requirements. Are you ramping up your power supply and capacity to these buildings, taking that into account? Or are you seeing people saying we need this much power as a multiple of what it might have been 10, 20 years ago?
So to future-proof the buildings, we talked about clear height. You have to have a lot of trailer parking and hardscape. So that puts downward pressure on FAR, for which you may or may not receive value out of the chute. But if you're trying to future-proof, you need that. Oh, and then there's the power. We could do a whole hour on that. Country's running out of electrical capacity. It's running out of uh, the capacity, the distribution networks it takes to provide that. That's a whole nother thing having to do with, chip plants and data centers and such. But in our little world, we're starting to see it creep now into our projects. And so utilities rightly want to serve the customer that's there, but they don't want to provide a lot of extra power because that capacity then goes to waste. And so there's a push and pull aspect to that, a chicken and an egg, if you will, because you want to be able to say to your customer base, hey, come to our building. We've got, 5,000 amps of power. We have more than what you need, but you can't really guarantee that because the utilities don't want to guarantee that service until you have a customer. And so, if you're building a spec building, you're typically trying to get a minimum service that you think is market acceptable and then adapt to the customer's needs. But it's a dance. And it never used to really be that way. But now everyone's trying to squeeze more out of the system that we have.
How do you juggle that? How do you juggle it if the power company is saying we'll give you 2,500 amps right now, even though you think that there's a viable case to have 5,000? how do you juggle that in terms of the risk that you aren't able to get that 2,500 down the road?
That's the point. You need to make an investment call that I'm not going to take that risk. That's not a project I'm going to build. And I never thought we would be there in this country. When years ago when I was with Prologis and we were investing in Mexico, for instance, one of the investment risks that was always in the memorandum was making sure we've secured electrical power. And I would read that and say, what do you mean electrical power? We just call up, Portland General Electric and they come out and hook us up. Yeah, it's not that way anymore. Not that simple. So it has to go into the mix around all your other risks and your risk mitigants.
Do you see solar tying into this equation at some point down the road where it could help perhaps offset
Yeah,
some of the supply and demand equilibrium?
in theory, and we're proponents of solar. All of our buildings are built uh, solar capable, and that means adding a more robust roof structure up front. But the solar laws and customs in every market really aren't built for serving the customer in the building. What they're built for is harvesting power off of the roof, putting it into the system, and letting a solar specialist provide the capital in exchange. They lease the roof from you, but the power doesn't really belong to the building. It belongs to the utility. And so there may be these where we're piping power directly into the building itself. I'm sure there are, but that's not typically how it works. And so I can't see a clear path to saying to my customers, we'll put solar on the building and we'll add another 20% of capacity. Even if I could, where in the country is it that that might actually work, given the celerity? Doesn't work in Chicago, doesn't work in Pennsylvania or Portland, might work in Phoenix. But even at that, are you really guaranteeing uninterrupted service? So
Yeah,
then
and
you get
then
into the battery side, right? Could you have a bank of batteries inside a building? Yeah, you could, but I think it's still early in the battery technology to think that you can, for industrial scale uses. I'm not talking about what we're doing at our home, but for industrial scale uses to be able to capture that energy, store it efficiently, and have it be a gap filler. For most industries, I think we're still a long ways away from that.
one of the topics that I'm very interested in getting your thoughts on is just the dichotomy between China's energy production outlook and the US's, and I'd extend that to North America as a whole. China at one point was adding a new coal plant every 2 days. They've got a ton of nuclear under development. They're almost in an energy arms race right now where they're trying to get energy wherever they can, and they are open to everything. In the US, the last one, we had one nuclear plant in the last 20 years that's come, and they were
In
trying to reboot
in
a few.
Georgia, I think it
Yeah.
was Georgia.
And we're
Yeah.
trying to reboot a few other ones were just like 3 Mile Island was decommissioned in 2019, I believe, and they're trying to bring that back online. The one that didn't have the meltdown. But aside from
Mhm.
that, we have no nuclear. There's a very anti-coal sentiment. There's even an anti-oil and gas sentiment, although that seems to have perhaps been easing a little bit, and people are accepting natural gas as a power generation mechanism. But aside from that, our supply is running really flat, whereas China is ramping up at an incredible pace for power. Does that
Mhm.
concern you 10 years out? And you're preparing for it, but does it concern you more outside of your portfolio on what does this grid look like in 10 years when demand keeps increasing at the pace that it's going versus the supply being relatively flat?
Well, everyone should be concerned, and I'm going to get into some commentary that's really beyond my expertise, but doesn't keep me from having an opinion. Everyone should be concerned about this. All we have to do is look at what's going on in Germany, where they have what I would call unilateral energy disarmament. And now the economy has been brought to its knees. That won't happen in this country because I think we've already turned the corner, and there has been a recognition broadly in this country that we have to have an all of the above strategy. And I think we're just now starting to turn the corner and think about what that means. So I'm optimistic that in the midterm we'll be able to solve these generation and distribution problems. But I'm a little pessimistic that in the very short term, say the next 5 years, we're going to have spot challenges. And we're asking ratepayers in many of our cities to pay these enormous upcharges because the environment, as you suggest, taking legacy generation offline before it's time for not political reasons or for environmental reasons or both. And we're asking ratepayers to pay these huge charges. And now we're going to layer on AI, we're going to layer on electric vehicles, we're going to layer on data centers. And a lot of that cost is going to go into these rates. And there's already in many communities a pushback on data centers. I don't want to pay higher rates so that my utility can accommodate the next data center. Let those people pay for that stuff. So this is already and will be more of a political question, I think, in our markets. But I'm optimistic that in the midterm we'll figure it out.
I don't know if you remember watching Back to the Future, which is put out in the 80s when they
85.
this is kind of off topic, but it relates to it. So at the time, Doc, when they were trying to figure out their time machine, there was a clip in it where he says, how much power do I need to actually generate to get this going? And he says 1.21 gigawatts. So unconventional. You'd say, I think 1.21 gigawatts now. He says 1.21 gigawatts. And then he loses his mind. He has an absolute meltdown at
Mhm.
how large that power is. Well, that's just
1.121 gigawatts.
it's an iconic scene. That's a data center right now. Like there's data centers that are 1 gigawatt data centers, and in some cases there's ones that are being planned that are even larger than that. So 30 years ago, this was an inconceivably large number. That's
Yeah.
just the data center down the street from us. So that's what I find so peculiar about this is that the demand for power, because we haven't even hit full electrification of the targets that at least the previous administration was trying to aim towards. We're nowhere close to that, and we're getting all this massive increase in demand, but the supply just seems it's finite, and there's going to be scarcity issues.
And yet, to continue the conversation, remember at the end of the film, he comes back with the flying car, and it's powered by Mr. Fusion, and he's got a banana peel, and he's dumping a Miller beer in there. Very, very appropriate product placement in a film. I mean, nuclear or modular nuclear reactors, I think, is something that we're going to start to see. If we can do this in the U.S. Navy for the last, 60 years, have them floating around in the sea without an accident, could we do that, at the neighborhood level? And politically, would that fly? And all the things that go along with that. But the technology is already there. So I think this, just to wrap up my views on the energy side, tremendous amount of intellectual capital is going into all things AI. A tremendous amount of money is being generated in that entire ecosystem. When you put together that kind of brain power and a demonstrated need for a solution, someone's going to come up with a solution to get us over that hump. I just don't know what it is yet. That's why I think the midterm is where there's probably more risk.
Yeah, very well said on that. So because I think that's what the US leads the world at is just technological innovation. That is,
Mhm.
there's always somebody thinking about a solution to a problem. So I agree. I think somebody will solve this problem. What do you see in 2025 here at factoring in all of that, factoring in the political landscape without getting political? Because I'm with you. I don't need to go near that any near more than I need to go near that banana in Back to the Future. But
Right.
what do you see? What's your forecast for specifically for the industrial real estate market? How do you try to read all the tea leaves and make forecasts for this year?
Well, we've talked about the capital markets a little bit. We've talked about the supply side of new construction. I think 167 million square feet was started last year on a base of 18 to 20 billion square feet. And so that's below replacement. If you take a 50-year life of an industrial building, so 2% goes obsolete every year. That's twice what we're bringing back into the market. And what I said doesn't account for growth in population or growth in e-commerce or some of the other secular trends. So we are way below replacement. That's going to manifest itself, I think, at the end of the year and into 26 and 27. What we haven't talked about is the supply or the demand side. And it's much more difficult to measure and to predict. Look at the US consumer and consumer sentiment and the consumer KPIs, and that will tell you where our customers are going with their business. And I would say right now that the signals are very mixed, that the upper half, let's say, of consumers generally doing very well, and the bottom cohort generally struggling. And you can see that in auto loan delinquencies. You can see it in credit card data and all kinds of other things. That's a flashing yellow light. And I think our customers are looking at some of that data and saying, am I really ready to pull the trigger on the next building? So that I think that's a downward pressure on demand. Upward pressure on demand is simply, hey, how long can I sit still in my distribution network before my competitors are optimizing theirs and I'm left behind? So the distribution network is part of playing offense. It's not just defense. And that's how companies win share. So you've got fear on one side, greed on the other. I think we're kind of somewhere in the middle right now for most customers. And so I think 2025 from a demand side looks fairly moderate to me. I don't see a gangbusters year of net absorption. And so I'm glad to see that supply is moderating. When that happens, I think rent growth moderates as well. Of course, that's almost a block by block, submarket by submarket thing. But taken broadly, I think rent growth to me feels like it's a 3 or 4 or 5% kind of rent growth year. It'll still be positive in most markets.
How do you explain when you're talking to somebody, maybe it's a shareholder or just somebody, a lender, whoever it might be, if they're not fully in tune with the market and they just read a statistic that says vacancy of big box in the suburbs of Phoenix is 12%. I'm just throwing out an arbitrary number.
Right.
And that's what they just equate to being a market average. And you might be in an inland empire where you're dealing with 4%. How do you explain the differences, or do you not even have to get into that conversation because the people that you're dealing with are sophisticated enough to understand those nuances? But how do you reconcile or square that circle?
Well, you're right. They're very sophisticated on the lender and the investor on the equity side. But you do have to explain the nuances because they look at, we're all looking at Green Street. We're all looking at the brokerage reports from the big brokerage houses, JLL, Cushman, CBRE, and others. So there's a lot of macro data coming at us. I mean, literally hourly. But what they rely on us for as a manager is to literally have block by block granular knowledge of the competitive set and where demand is coming from, making sure that when we build a spec building, we're building into the fat part of the demand curve. I don't want to build a 100,000-foot building in a submarket that really wants 500,000-foot buildings and vice versa. So that's where we're really called upon to provide guidance and to fill in with our own anecdotes and our own data some of the macro stuff.
Yeah, and you mentioned earlier that data is just so important for that regard. What else should people really be paying attention to right now? They follow the macro trends, they're reading the reports, they're trying to get as much data as they can. What are some of the things that people should be thinking about that perhaps it's not even on their radar right now?
Invest in assets where you have a sustainable competitive advantage. To do otherwise is to float along with the tide. And you can do very well when the tide is rising. Remember that many of us in our investing career don't really remember a time of rising interest rates. Interest rates have been flat to down since what, 2008 to 2022? Call it round it to 15 years. That's half a career. And so now we have to go back to the fundamentals. Is this a project that has a sustainable competitive advantage where I can grow rents over time and where I have liquidity at the end of the day when I need it, both up front and on the back end? Or is this a project that's a Me Too project where I'm going to have to rely on the tide of rents rising or the tide of cap rate falling for me to be successful? I think now's the time to stay away from the latter and to be
You
disciplined about that.
The discipline is key, and you mentioned the different lens perspective between a GP and an LP earlier. What does a GP do that needs to be busy for numerous reasons? And what do you do
Yeah.
if you're an LP and you need to be deploying capital right now? Is it the discipline to avoid making a bad decision being a good decision? Or what are you, how does the average person find opportunity right now to get what you said as like the great asset in a protected area where you've got a competitive advantage? How do you find that, and what do you do if you can find it?
I'm going to answer the LP piece first. LPs are generally very conservative right now. Their committees and their boards are under the working impression that rates are going to be higher for longer. That's the mantra. And so they're much more bearish on investing in risk assets right now than they have been. And so there's a natural governor on their level of interest. I'm talking about institutional LPs. On the GP side, you raise a really good question. In this part of the cycle, how do you keep the lights on? Because your whole way of generating revenue, if you're a private developer, is to develop. And when it's not time to do that, or it's not time to do it in the same scale, you have to right size your organization. And I think we're going to see some right sizing coming amongst the subset of private developers in 25 and 26. So that's a constant. Now I forgot the second half of your question. I'm sorry.
Oh, I do that all the time. Yeah, I sometimes will just go on a train of thought where I'm like, well, I should add this question on as well because it kind of relates. So don't feel bad. That's my fault for
Oh,
trying to layer
I
on
know
too
what
many
it was.
questions.
How do you find these nuggets?
Yes. Yeah. Where do you find the deals right now?
If it's just old fashioned relationships and market knowledge. And so getting embedded in the fabric of the community where you want to invest and being the first or second one to hear about something, not the 20th, because all your money is made the day you make the investment if you've made a wise investment. And the opposite's true. And so to find those nuggets, I like to call our people, we're hunting for truffles in the forest. We're sniffing around the ground trying to, and my team hates it when I describe it this way, but trying to find that 5 pound truffle, that's worth $500,000 or something. But it's really just that. It's just really having a granular knowledge of your product type, your patch of the world, and mining that and farming it, and whatever other metaphor I can use. But just taking things as they come to you from the brokerage community. Some of that might be gold, but a lot of it's been shopped. So if you really want to, as an investor, stick to something that you know better than everybody else.
Do you have plans for a more development this year, or are you looking to buy? Is there an outlook on what you guys are expecting to do this year?
Selectively, I want to build into this market because I believe in the rent growth story and I believe in the supply cliff that's coming or is here now. And because I'm building into what I'm going to deliver in the end of 25 and into 26 and beyond, I think I'm building into a good market. So I'm taking a little bit of a contrarian approach and I'm not running with the herd. Now, we're not the only people, but that's the approach that we're taking. So we will probably increase our starts this year from what we did last year. What we did last year was a fraction of where we were at COVID peak. So we're not going back to that, but we're going to selectively build into submarkets where we have very high conviction. In order to do that, we're going to be competing with a number of people that have the same outlook and have the same level of liquidity as we do. So we're going to have to be better. We're going to have to use our relationships to get to the best things. At any given time, we're looking at, say, 200 deals in the marketplace nationally. We're going to make 10 to 12 deals a year. So we're sifting to get to those that we really think fit.
Do you have more of an emphasis this year on building versus buying existing?
More on building. A couple of years ago, we were able to acquire and we think add value, but a lot of people came into that space very, very quickly. So a couple of years ago, we would make an offer on a building that we really liked. We bought a building in Savannah, right outside the gates of the port, 300,000 feet. A Japanese tire company who's the main tenant there. A couple of years left on the lease. Rents are way below market. We liked the asset, so we acquired it with the expectation that we're going to be able to roll those rents up when the lease expires. Those sorts of opportunities now have become completely overbid. When those come out, the bids are 25 deep. And so all the value is squeezed out of it. I have a great good fortune of having a very mature national development team. So if buyers are going to pay up for that kind of product, I want to turn from being an acquirer to being a manufacturer. When it reverses, I can go back to being an acquirer. But right now, I'm more inclined to be a manufacturer.
Yeah, that makes a lot of sense. I remember on the first interview that we did, we closed up by either you brought it up or I asked, but is there anything that I haven't asked you? And that was the general tone of the question. And I kind of want to ask that same question. Anything that I haven't asked you in this interview that I should have asked or that you think is worth exploring perhaps down the road? Because I'd love to do part 4 on this at some point down the road too. So trying to tee
Okay.
up, is there another topic? You mentioned power could be one. Anything that I
Yeah.
haven't asked you that we should have on our radar that we could perhaps tee up for another episode down the road?
We haven't talked about political barriers to our product. Let's face it, we build buildings that attract trucks. And although everyone wants something delivered to their home by 2 o'clock the same day, they don't want to see a truck running around their neighborhood. And I totally get that. The political barriers to new construction in several parts of the country are accelerating. Many of your listeners may know about California, what's called AB 98.
Mhm.
It's a new law that puts severe limitations on construction of new distribution facilities that are near what they call sensitive receptors. On top of that, we have communities in the West and the Northeast that have outright moratoria on new construction of warehouses. So not only are we having to understand power, not only are we trying to understand the supply and demand dynamics, but now we find ourselves in a place where the political environment in many places is working against us. And on top of that, we've had situations where we have signed development agreements, duly signed, recorded, agreed to, that in some cases are months or years old. And the township or the town or the village just says, you know what, sue me. I'm not
Wow.
letting you build it.
Wow.
And they're being responsive to their constituents because there may have been a prior administration that signed this development 3 years ago, anti-warehouse, anti-truck uh, communities start to form, and they just renege, straight up renege. I don't know where to go on those. We negotiate in good faith. We provide all the mitigants that everyone agrees to. Hasn't happened very often, but there's a couple of these where there's actually a sense of lawlessness about what government says it's going to do and what it actually does. That's still the exception. I hope it doesn't become the norm.
Well, hopefully, because in my experience, sometimes when one of those grassroots movements takes shape and they're successful with it, and perhaps in one of those scenarios where they are able to uh, prevent a data center or a large logistics center from coming into the neighborhood, all of a sudden that becomes a case study, and other communities are like, well, those guys did it up there. Let's figure
Yeah.
out what their playbook was. And I'm with you. Everybody wants 2 hour shipping. They just don't want a warehouse next door. So there's that
Mhm.
imbalance between what people want and to get, and then what they want to have there.
Yeah,
But
and
that,
I should hasten to add that we don't want to go where we're not wanted.
mhm.
And so we focus on areas where they're traditional uh, industrial areas. That's why I like tearing down old manufacturing buildings. What I bring to bear is an improvement over what was there. But when you're going into greenfield and you're going into suburban communities, you start to get this kind of pushback. And AB 98, I could tell you, is coming to a state, county, or municipality near you.
Yeah, and that you speak to the challenge on that is that if you are negotiating in good faith without thinking that there's even anyone opposing the project, and you just think that you're going ahead with the development as anyone else would, and then you find out 2 years into the process that it's now being rejected, how do you actually figure out what the rules are? So that
I
that
don't know.
that adds to the
Yeah.
challenge.
We have to have a rules-based society, and we follow the rules, and we want our partners not. I should hasten. This is a small subset that we've run into, and I'm hoping it's not a trend. And I put myself in the place of the village president or township mayor. They're under tremendous pressure to reverse what might have been agreed to 2 years ago or 5 years ago. So I totally get the dynamics of that. It's just when you have these shifting sands, it's very difficult to make investment decisions. And then they get the lawyers involved, and then no one's happy. But now let's flip this around. That puts downward pressure on supply.
Mhm.
That means the existing stock gets more valuable. Well, I'm an owner of existing stock. So while it might be hard for me to add to that stock, what I have becomes more precious and more valuable.
And with that comes more rent, and in the form of rent means that the company's paying it. So what are the inflationary effects of that, and what does that mean if companies don't have enough space to choose from, they get pushed into higher prices. So
And
it's
that's
great.
why some of these are going from the Inland Empire and they're considering Phoenix and
Mhm.
Reno and Las Vegas.
Yeah, there is a lot to discuss there. If you're up
Yeah,
for it, I'd love to reach out to you again in a few months, and perhaps I guess we're already March. Tomorrow's March, which is crazy. Perhaps we
yeah,
could
it
look
is.
for something even early fall, just to see how the year has gone forward, and then jump into those moratoriums and that political environment and opposition, because there's a lot to unpack there. 'Cause I agree. If you restrict the supply, then that doesn't happen in a vacuum. There's other things that transpire as a result of that. So I'd be very curious to unpack that more with you down the road.
Happy to do it. Thanks for having me today. Great to see you.
Well, you definitely delivered as always. I had no doubt. Part three was just as good, if not better, than the last two. So thanks, Doug. I really do appreciate it. I'll leave links to Dermody Properties. Anything else? If someone wanted to reach out to you and connect, any other way to do it, or is Dermody Properties
Uh,
the best?
Dermody.com is where you can find all of our information. And yeah, we're pretty publicly available.
Okay, I will include that in the show notes. And yeah, just wanted to say thanks again for taking the time to do this. I really appreciate it.
Thank you, Chad. Much appreciated. Take care.
Okay, thanks, Doug.